My sense is on interest rates, what is less important is than how much they rise or how quickly they rise, but why they are rising. Am I right on that?
Yeah, thanks, Tyler. I appreciate you guys having me. You kind of took the words right out of my mouth. It's really an it depends story. If this is slow and steady and it's the result of economic growth, that's good news. We want the economy growing. So economic growth is not something to be scared of. If the Fed thinks it can take, their foot off the quantitative easing because the economy is in good shape, that's good news. As you kind of note, it's kind of how much of that can we handle. If they go materially higher, there is a point in which that's bad news, and why we're doing it.
But here, what do you think the rising rates are telling us? Are they telling us that inflation is more intransigent and not transient, number one? And number two, is it telling us that we're at a point where the economy is maybe getting ready to slow down a little bit?
Yeah, I mean, I think if you look at the equity markets last week, it might be telling you something that's in between, which is that I think everybody looks at the current inflation numbers and they don't exactly look transitory. But at the same time, I think what the equity markets applauded last week and believes is that the Federal Reserve stands ready to do what it takes in order to keep them in check. And they're moving slowly and smartly. So I think the equity markets are saying they're going to start easing, but they also seem to have our back in the sense that if things start to go awry, we seem to trust them to stop that.
Greg, let's talk through, as we sort of contemplate these larger themes, some of the names that you think are poised to benefit. And there's not a lot of obvious rate plays here, not a lot of big banks or anything like that. You have United Healthcare, O'Reilly, Texas Instruments, right?
Yeah, absolutely. And I think you hit the nail on the head. That's actually intentional. I think for long-term investors, it's often difficult not to get caught up in what currently is being obsessed by the market. And currently the market's obsessed with getting the inflation call correct, the interest rate call correct. And so half the people are going to be happy and half the people are going to be sad. We're long-term wealth investors. Oftentimes in the midst of this, and we think is the case now with these three names, secular growth stories get left aside. They're a little bit less interesting because they do not touch upon those hot button issues that you mentioned.
Yeah. So also, I think in here you mentioned the kind of persistent issues with worker shortages and labor issues. And, we're obviously seeing supply chain problems more broadly. Is that anything that you have to factor in as an investor here? Is that something you also is it possible to sidestep, or do you just hope that companies are going to kind of figure it out? It just seems to every day we wake up, the news is worse.
Yeah, I think it's something you have to be very mindful of. Frankly, relative to the inflation story, I'm much more concerned about labor than I am about inflation, because the Fed can impact inflation, and I don't know that they can do anything if labor keeps being an issue. So as we enter 2022, that's something I'm really watching. As it relates to the names we're looking at, we are certainly cognizant of whether or not labor is a problem. And in some sectors, it's a big problem right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.